We have both some of the best and the brightest in our region and in general. We have Nate Lentz from Osage Ventures, Doc Parghi from SRI Ventures, and Mindy Posoff from Golden Seeds. I want to thank each of you for joining us. And I do feel like I'm a little bit of like a TV host here, especially with my fancy background. And we're going to kick it off with some straightforward questions. Last but not least, I know most of you have heard this already. There is chat at the bottom. We want to make this as interactive as possible. I only have 6 or 7 questions, so start to ask questions as they come to mind. This is about giving you the feedback and the insights and any benefit that we have in terms of what we're seeing. As a quick introduction, as you know, Ben Franklin, there are about 260 companies in our portfolio right now. The more that we can stay connected as a community, the more feedback and assistance we can give each other, I think the better we're going to end up when we come out on the other end of this, whether it be 30 days from now or 30 months from now. So with that in mind, if each of you want to just do a quick hello and
hey,
I
Scott.
thought maybe both I'm sorry?
Hey, Scott, JB, real quick, just to make it clear to everybody, you see in the upper left of your screen, we are recording this conversation, so we want to share this out with all the portfolio after we're done. Didn't want to get in too far of the conversation without making sure that everyone knew that. So thanks, I'll go back on mute.
Great. And so maybe Nate, throw it over to you. One quick introduction on yourself and Osage in case they don't know. Great source of follow-on capital. And then wanted to just kick off the first question with what you are seeing as the most asked question that you're getting, and obviously your answer.
Great, thanks. Yeah, Nate Lentz, Osage Venture Partners. You know, we're an early stage fund. You know, we write $1 to $5 million checks, B2B software on the East Coast. So we've got a number of companies in the broader Philly area. We've been doing this for going on 15 years and have been through a couple of financial crises along the way, but this one's pretty unique. You know, I think the most frequently asked question in the last couple of weeks is really just the question of what are the available capital sources? What or how we can get access to some of these programs, getting DC, and you know, what are some of the criteria requirements around that? Because there's a lot of buzz, there are a lot of dollars, there may be some things that really help out a lot of companies, and yet the playbook's still getting written right now. And so we're working with the venture lenders, we're working with the sort of attorneys in the region, and trying to get as much information as fast as possible to our portfolio companies. And our answer to most of them is fill out an application if you think you qualify, start the process moving. You know, the rules are getting written, but you don't want to be at the back of the bus. And so you want to act as quickly as you can, because this is money that's going to go a long way to saving jobs and really extending your runway.
Great. Thank you, Nate. All right, I'm going to throw it over the fence to Mindy, and if you can unmute. And what are you hearing out there?
So good morning, I'm Mindy Posoff. As Scott said, I'm an angel investor with Golden Seeds, and we're more in the 1 million and 250 to 1 million writing of checks. We work with angel groups across the country. So a lot of our companies are probably pre-revenue or right at revenue, building tech or just about springboarding the companies. And I would say, I would switch it differently for us. We try to provide sort of leadership and ask the questions in the middle of the chaos. So the first question we always ask, besides how are you and how are your family, because I think this is a unique situation, having lived through many different crises, are you all safe? And asking the CEO what their own self-assessment is of the situation. So sort of a self-awareness to help him or her, in our case, a her, usually to focus on leadership at this point. And leadership really being around a self-assessment of your surroundings, your company, the market, where are you? Have you started to look at, and this would be like right in the beginning, a COVID-19 budget, and first and foremost, where's your cash? How are you thinking about your business? What do you, what hit have you, if you're about revenue or about building technology, where are you? How can you extend your cash? Cash is, as Nate said, there will be money, there is money that will come into this market, but the most important thing here is to really extend your cash and focus on what your business is. So really thinking about the strengths and the weaknesses that you're looking at your business, at your market. Is your market there? Has your market pivoted? Where's the market going to be in about a month or 2 months? And then really a deep dive assessment we've been working through around sales pipeline. Have you talked to your clients? What are your clients thinking about? They could also be great opportunities for cash or partnership down the road. It's not the time to ask them about a budget. It is time to help sort of think about opportunities. And the other thing that we talk about a lot, and I sort of said this in the beginning, is leadership. And that is communicate, over-communicate as much as you can. Communicate with your team, provide a sense of optimism in this insanity. Really think about transparency and what you're thinking about the game plan, and then over-communicate with team, clients, if you have clients, your board, and the investors. Because as we move through this, developing that sense of leadership and loyalty will lead to a better way to raise money and build your company.
Thanks, Mindy. And Doc, before I throw it over the fence to you, I'll give my 2 cents. I'm going to mirror Mindy's comments about cash. Cash is king. I think in some of these situations, for some of the companies out there, just surviving is going to be a criteria for success. And so, the person who's still standing wins because they're still standing and the other one isn't. And it's not just about getting to the end of that journey, meaning, you're still standing at the end. It's how much damage you take during the process. And fundraising, especially in a market like this, is really hard. I'll mention Ben Franklin is still open for business. We are still investing in companies. We are still putting out capital. We are still here for you. Keep in mind that there's only so much money that we have, especially in light of what's happening elsewhere in the world. And so we need to see that our money goes after into a good company that we feel will still be standing. We can't put good money after bad. And I think that's a big criteria. So cash conservation, and having a plan to get from here at point A to point B. And at this point, that's an indefinite plan, and that's important. So that's my 2 cents. That's the question I get the most. How do I get more money from Ben Franklin? And the answer is give us a plan that shows that you're going to be long-term successful. That's where you get more money from us. So Doc, back from my site in Colorado, give us your 2 cents, please.
Yeah, absolutely. Thanks, Scott. So I would say, obviously, I will echo what the others have said. Cash is king. We're working very closely with our companies just to kind of retool their budgets. Obviously, the revenue targets, at least for now, almost don't matter because they're not going to hit them in many cases, right? So we're making sure survival is key, and also it's a good way for us to evaluate the entrepreneurs because we're oftentimes on the request for more cash to see how they're thinking about it, how they're thinking about the business, how they're thinking about retooling to take advantage of the situation and try to help their business and how quickly they can move. So it's actually an opportunity for us to see how they move in terms of crisis. In many cases, some of our entrepreneurs, this will be the first time they've gone under crisis. So it's a good way to evaluate. But cash is king, and also a good opportunity to relook at your business model and see how you can kind of retool the company to take advantage of the situation, whether it be retooling the product or offering to take advantage of the remote working that we're doing now, things like that.
Got it. Excellent. So we are getting questions. I just want to share before I get into the question from Mike, and thank you for the question, Mike. Please others ask. This panel, and I'm looking at the names around. I think most of us have been through the dot-com bust, and then 9/11, and then the financial meltdown, and now the COVID pandemic. And so the whole, if you will, black swan issue is not new. I think this one it's new of itself, but the whole point of a black swan is an unanticipated surprise that throws everything out of whack. And so I want to ask the panelists here around the table, is there cash conservation we get? Is there a way to prepare for the unknown as a startup? And what advice would you give them? Doc, I'm going to throw it back to you, or if one of you wants to jump in and take that one.
No, that's great. I actually have a view because I've seen at least the crisis that I've seen in the last few decades. Right. So let's start out with the dot-com bust. We're part of a product company, a startup. The bust happened. We shut down the product company and then kind of rose from the ashes of that and developed a service company that we completely retooled and then started getting traction. Unfortunately, we had a 10-year run and a decent exit. So from the entrepreneur perspective, I saw it. And from the last two busts as an investor, I would say, really what the entrepreneur should be doing is thinking, you got to throw out the old norms in most cases and think about how quickly you can adapt to the current situation, right? That's the adaptability, the ability to pivot. Heck, you can pivot several times. This is a good opportunity to try to find that winning piece to take advantage of this. So really, it's to be flexible and be completely open. We have some entrepreneurs in our portfolio who are not quite as willing to pivot, right? Even though there's some obvious things there. So that's something that we also have to consider when there's requests for more money, right? But I would say that is the one thing with all these cycles is be flexible and be ready to retool. I have a few more to add, but I'll give the others a chance.
Good.
So I would just add to that. When you assess the world, to look, there are opportunities there, and the good companies, they may actually need to fold and as Doc said, maybe retool or pivot, but they might also look for acquirers depending on where you are, or merging with partners depending on what you need. And as an investor and board member, I don't always know that, so I look to the entrepreneur to really start thinking how they can survive. If your industry that you've been focusing on, you have tech for an industry that's just blown up, is there a way to join forces with someone else to recreate something or to focus? So pivot, focus, or recreate, I think is really important. And it's hard when you're trying to juggle everything at once, but as a leader, that's what we're investing in, right? There's not always the right answer, but there's the people who look at the answers and say, here's the opportunities. And I just want to underscore, I've lived through all these different scenarios as well. Some of the opportunities is to fold. You may not make it, and that's okay. That is okay. Or you may have to take your valuation down in half, and that's okay too. It just, these are things you have to assess.
Thanks, Mindy. Nate, anything to add?
Yeah, so we've taken a look at our portfolio and we've sort of take a look at the companies and looked at them on two dimensions. One is how much cash runway or flexibility do they have right now, and part of that is the cash they have today, and part of that is with their revised plans, their revised budgets, how far does the cash take them? And the other is which companies are going to be more versus less adversely affected by what's happening right now with COVID-19, and then also if you assume that there's going to be some kind of a post-COVID recession that carries through, which will do better or worse. And we run from companies that are in the online education space that have never seen their phones ring as much, and we have companies. We have a portfolio company with 1,100 restaurants as their customer base, right? So you can have both those extremes. So I do think that depending on where you sit, you've got sort of a different view of this world. At the same time, the advice we've given everyone is what it happened in 2008. It happened in 2000. The first thing that happens is everyone freezes. So there's a freeze period. Buying cycles stop, right? Even though at the end of the day, like in the B2B software space where it's driving some efficiency and savings, you tend to see decent resiliency even in a recession. For a period of time, it's just going to stop. So you have to survive through the period of just major inaction. And whether that's consumers you're selling to, or whether that's in the B2B space, or whether you're a life science company running clinical trials, you can't even run a clinical trial right now because people can't get out there, right? It's a freeze. So you get past the freeze and then start seeing what the market looks like. And so I think you just have to expect that that's going to happen. It's happening to everyone. You've got to get past that. And then you need to start thinking, how do I come out the other side stronger in a more innovative way? Maybe it's a pivot. Maybe it's just a slightly different offering to really understand what your customers' needs are. But that's I think recognizing that the freeze is what it is. We don't know if it's going to be a 1 month, a 3 month, or a 6 month freeze. But you got to plan for it being longer. Plan to come out stronger on the other side if you can.
Yeah. And I want to thank you. I want to turn it over. Mike had a question about, where and how far and how deep, what are the milestones, cash versus burn versus cutting versus furloughing versus R&D, where and how. And Mike, I appreciate your comments about getting the state of Pennsylvania to help and the federal government to help. We are all over that. But that's a pretty big ship and tough to steer. But we are constantly giving feedback to DCED and others. We appreciate their support. We will continue to try to get their support, but there is a lot out there. I would answer that question by saying, how much you burn is a function of how much you grow. And in a world where, no one is really expecting growth or high growth, then you've got to try to shift that equation so that your burn is decreased. And so I personally would, in that question, would say all of those things, to the extent that you do not cut the core. And for me, that's the key message, which is there's a core capability in orthogenerics or anywhere else. As soon as you cut the core, it's really hard to recover from that. And so how deep can you go without cutting the core? And only you as a business owner, because that is a subjective definition. I don't know if anyone else wants to, in terms of, where that line is on the panel of how you know where the line is and what's too much and what's not enough.
I mean, I would think that we're guiding all of our companies to try to get visibility to at least a year of cash. We've got companies that everyone who had a bank line has taken it down. Everyone is looking at the cost structure. Everyone's looking at the federal programs, whether it's the SBA loans, which no one's counting on yet, or whether it's understanding how the use of furloughs can actually let you hold on to your people, but that'll take down your burn for a period of time. You should be going and talking to your investors to the extent that they have visibility. Like, people are coming and talking to us. We know that there are companies that we know will back. We know there are companies that we're not sure. So based on what happens, there's some that we know that we have no more reserve for, just whether it's from an old fund where there's no more reserve. Find out from your investors what might be available as well. Use all of that, cutting costs, pulling down capital opportunities you have. 12 months feels like the right kind of measurement at the shortest term that you want to be able to look forward and say, I've cut my plan. I'm assuming much less revenue, and make a cut on your assumptions and then reality check it again, and make it as conservative as you can and try to get to 12 months.
12 months sounds like a good number. Doc, Mindy, you want to pile on?
Absolutely. Yeah, absolutely. I think that is the milestone there, or the benchmark that we're using with our companies, is get 12 months worth of cash. In our case, we primarily invest in software and technology, so it's different versus biotech, right? So when our companies cut, oftentimes the founder is the vision, probably the technical person is also the CEO. So you have that knowledge base there, and so oftentimes the founder he'll cut deep. We have a company right now. He's cutting it. He's cutting the development team to the bone because he is the IP, and he just said, I'll build it back up. And this is without any prodding for us. But that's what we like to see, is, not afraid to take the drastic steps. So like I said, in our case, I think it's looking at all types of costs, looking at real estate, looking at your infrastructure. I mean, all of that should be on the table. I always tell our entrepreneurs, don't tell me what you can't do. Tell me what the art of the possible is.
Yeah.
And I say that's really, that's really what I think separates the really gritty entrepreneurs.
And Mindy, before or well, rather than answer, let me expand the question, because I think the 12 months feels like a good answer. It feels like something that you should strive for. I can tell you there's probably people on this line where 12 months is not realistic from where they stand today. And we've talked about, or we've all looked at the CARES Act and the SBA relief program and some of the DCED, and PIDC had a program that's oversubscribed. So there is dollars out there. But the challenges with those, and Tom, thank you for the question, is that they want you to already either have revenue, and so that does eliminate a fair amount of our companies, or they want a personal guarantee. So my question there is personal guarantees for a technology startup. Where do you land on those, and are there alternatives?
So a lot of our companies are pre-revenue, and interestingly, we are keeping to our schedule of looking at follow-ons and opportunities, and we're doing quick due diligence and deep dives. And I think it was Nate who said, some of the ed tech companies, I mean, they went from, plodding along to the world is, in a light switch, online education, et cetera. So I think for us, first of all, we always want people to have sweat in the game. So I don't know that we're looking at personal, like writing, your house and your mortgage versus putting it all in there. We want to see, so for people who have less than 12 months, which is hard when you're a startup, if you haven't asked the questions that both Doc and Nate are talking about, which are, how are you cutting? What's the reality? What's your COVID-19 plan? I can't answer that. That's yours. You have to know your own numbers. You have to give it to me and own it. And you have to have your own new dashboard. You've got to have 3 numbers that you're looking at. What's your weekly burn in some cases? How are you going to move this forward to get to that 9 months? And I think there are many angel investors, from my perspective, who will, in the next few weeks, as the markets stabilize, as masks come on board, as we get above the curve, I think there'll be some reality to trying to help those that they can see, as Nate said, can move out further. So I don't know if I've answered the question, but that is the perspective.
Appreciate it. Either Doc or Nate want to expand on that? Otherwise, I have another one. Okay. There is some question around supply chain. And because if you think about, if you don't have the raw materials, if you don't have the product, if you don't have the customers, whether you think about supply chain as physical product or someone to target, that's disrupted. Tom asked a separate question about, he wants to keep his lab open, but doesn't have the reagents. So are there sources or solutions where, if you're trying to get things out of China and it's just not coming? I think it is, from someone who his job is to build businesses here and have businesses here, is there a local PA alternative? I'll throw out there, Tom, that DCED, the IRCs, DBIRC, some of the other local support entities are there to help with that. I do think if there's a fundamental, I can't get it, I'm not sure anyone has a magic wand for that, but let me throw it out back to the panel of how are your portfolio companies handling disruptions in the supply chain?
Yeah, it's a interesting question, right? Because we're primarily in the software game, but we do have a few deep tech investments where there is a manufacturing component. The one company, it's interesting. They were originally, before we invested them, originally looking at Chinese manufacturers, but we said because this is deep tech and there's potential CFIUS issues, should move the manufacturing out of China. So temporarily they moved it to Singapore and India. but just a month or two ago, they saw they finally realized that they should look at U.S. options, and they literally just signed up with a manufacturer. I mean, they signed the contract 3 weeks ago, so go figure. So essentially in the last 6 months, they moved the supply chain from China to Singapore, India to U.S. So I think that was better. That was more a function of luck versus brilliance. But I would say the point being, you should always be looking. Again, this is the metal or the grit of the entrepreneur. How do we shift? How do we adapt? If you have overseas developers, how are they impacted? If not, can you move some of it here? Things like that. You should always be looking at ways to, I guess, I won't necessarily say do more locally, but adapt to kind of what's now the new normal.
So Nate said something on one of our calls that I want to sort of underscore, which I think highlights what Doc said, and that is, we're a community, and I know some companies may have to lay people off, and some companies may need to be hiring. So as a community, I can't answer your question in specific, but as a community, the answers might be in what we've built here in Philly Impact or Philly whatever, right? There is a local entrepreneur we all probably know, and she's been spearheading how to use the maker market for small manufacturers to make masks for healthcare workers, right? And has gotten some funding from some of the healthcare and materials companies here. And it was through a conversation, like through thinking about it. So some of the answers may be in this community, being able to find alternatives.
So Mindy, that's a great point. So we have a local company that essentially gets restaurants online, to enable online ordering. So they had a few thousand customers or restaurants as customers, but obviously they are absolutely booming now. Just last week, they added more customers or more restaurants than their total customer base. So they're absolutely booming, and to the point where they need to hire. And again, this is the grit of the entrepreneur. They need to hire to get folks onboarded, customer success, things like that. So he created a plan where he's looking to hire all the furloughed and restaurant employees and to help them with customer success. I thought that was brilliant. That wasn't from our suggestion. That's something he did himself. He's using that plan to try to get additional, assistance for the hiring from Pennsylvania, from Texas, and from Illinois, just from that thing. So again, Mindy, to your point, it is great. As his solution was right in front of us.
Right. That's great. And I do think I will give you, without the names, we had one company that had to furlough a whole host of manufacturing employees, and we essentially transferred the whole crew over to another one that was ramping up for it. So love those. We can only do that as Ben Franklin, as the intermediary, if we know. And so, I'd encourage everyone on the line, you do have an investment professional that is your point of contact. Let us know what's happening. Ask for help. If we don't know, we can't help.
So that just goes to sort of, as a leader, underscoring communication. Communication is not just to your team, but communication, talking, and I don't mean texting, calling your customers. We're all sitting at home trying to figure out what's going on. Listen to what they're thinking. And there may be a way to help. It may not be revenue today, but it creates a sense of loyalty and empathy that we're all in this together. The same with your investors. I think Nate said, talk to your investors. There are venture funds that are early on that will need to deploy cash to companies, right? There are super angels that may back out because the market just tanked on them, but there are angel groups that may come in because they've been sitting on the sideline because prices are too high. So the more you communicate amongst yourselves as a community, as well as your own customers, board members, if you haven't had a board meeting or board call, do it today. Lean into your board and lean into your investors. And the other thing I want to say about fundraising, the first question I will ask is, where are your funders? Like Nate said, some of them may just be done. So I need to know what the value is of your current funders as well. So communication, I cannot underscore that in chaos, is so important.
Thank you.
Yeah, I don't want to be redundant on this, but just one thing I would add, this came up in the most recent Ben Franklin board meeting, which is this community as a whole is seeing levels of cooperation across all sorts of organizations and groups that I think no one has ever seen before or anticipated. And I think that's just a common theme. No one should be sort of afraid and alone. Everyone's a bit afraid. It's an uncertain world out there, but reach out because there may be a solution in this community for the supply chain shortage or the challenge or the thing that you're wrestling with. And so ask the questions, treat this Ben Franklin community as a group, think about other communities that you're part of, and really reach out, because I think that in a strange way, this is making everyone look outside themselves.
Yep. And I'll throw out a commercial message. The Ben Franklin team has been trying to aggregate information and resources, the best of the best. We're all getting, a lot of emails about this and that, and where I will suggest, if you're not sure, on our website, there is a link, and we've tried to do a good job organizing all of the information, all of the sources, and it's in most of our social media locations. So you can find us on Twitter or Facebook, or, God, I feel like I'm giving a commercial message, but on the website, we'll give you the resources. I want to address a question because, Mindy, you highlighted or had a question about fundraising, down rounds, because I do think it's in people's minds of, can you fundraise right now? Should you fundraise right now? And what should be your expectations going into that? If your revenue's down 50%, is my valuation down 50%? So let me throw that one out there. I'd love to hear from all of you.
I'll let the VCs go first.
Nate, sacrificial lamb.
Sure. Can you hear me okay? Scott, you're coming through a little unclear, but can you hear me all right?
Yes.
Okay.
Okay. Yeah. We've had a number of discussions about this. It's interesting for us because we actually do have a fund that just got launched in January, and we do have a mandate to deploy capital. And so how do you think about how to deploy capital or structure in such an uncertain environment? What I would say is if you don't need to raise capital right now, then sort of delay it. Again, if you've got the ability, because we're operating in such an uncertain world, as investors, it's uncertain. So we don't know how long this freeze period is going to go. We don't know how deep the recession could be on the other side. We don't know if you were growing at 150% going into this, what your growth rate is going to be, 9 months from now going forward for 12 months. It's really hard to know. And what that means is that we're more likely going to lean to a structure that has some more variability to it. I think that it's most likely that we're going to lean towards doing convertible rounds with caps as opposed to doing priced rounds, because there's no way we can price that's both fair to the entrepreneur and fair to our LPs, given the amount of uncertainty that's in the market right now. And we'll try to pick a cap that tries to strike that balance. And that's sort of where we've come out as we've sort of wrestled with. We've tried to create a bunch of innovative structures that tie to certain benchmarks, what happens with the market, and also realizes that all you're doing there is creating massive complexity in a market that really doesn't want to deal with complexity, and that'll really mess up cap tables. So I see Mindy and Doc nodding their heads, which is good. I think you're going to see more structures like that leave the stake in the ground for sort of final pricing to the future when things settle out, and that balance the risk and reward in investing currently.
So let me summarize what I thought I heard before I turn it over to Doc. Yes, you're investing, but typically debt, conversion cap, and hopefully the market as it meets equilibrium will be able to dictate what the valuation is. Does that sound right?
Yes. Yeah. And by the way, I think that people should be raising smaller rounds. You shouldn't be raising a lot of money under that structure. You should raise enough money to get yourself 12 to 18 months under a more constrained burn level, and then expect to raise growth capital and not sort of stuff for the dilution. If you were looking to raise a $7 million round before, you should be raising a $3 million round right now. So I think that rounds will be smaller and they'll be structured differently.
Doc?
Yeah, absolutely. I think Nate, you hit it on the head with the convertible notes. That's exactly what we've done. We are also, less than half deployed in our funds, so we do have to deploy capital. What we've done in the last month, though, every deal that we've done has mostly been follow-ons to our existing portfolio because we got to support them first. We have a couple deals in diligence for new investments, but I would say the filter is much stronger, and where we like to close in 60 days, this may be 90 to 120. It gives us a chance to see how the operator is handling things. But broadly, absolutely convertible notes. But it's also a good opportunity for the investor, again, to see how the entrepreneur is thinking about things. If the entrepreneur comes out and says, hey, I need money, okay, great. How are you retooling your business? And if we feel he's not going, fast enough or deep enough with the cuts, that says a lot, and we'll probably put him on the list and move to the next person. So every deal we've done, we've literally had our existing entrepreneurs who generally come to us and said, okay, times are bad. Here's my plan to survive for the next 6 to 12 months. I need this much money to get me to this. He has milestones and something for us to evaluate. I always say that if investors are taking time with their companies, then the entrepreneurs should also be giving back and really come with well thought out plans. What you should not do is go to investors and say, I need this. I need X amount of dollars without a really strong plan as to what the use of the funds are. And also to mirror on Nate's point, absolutely take less than you think than you want, because eventually this too shall pass, and you don't want to kind of saddle yourself with unnecessarily larger round with potentially the valuation that you weren't hoping for.
Mindy, more to add?
No, I agree with both. We've had a couple of our companies who were just plodding along, who have gotten some amazing incoming calls to if they sort of move X or do this. And I've seen a couple 100,000 get written very quickly. So it depends where you are and what it's for, but I underscore exactly what they're saying about don't over raise in here. Notes are what we're looking at. And I think I said this before, I won't look at an investment, and I think any of us won't, unless you have this sort of thought out. And it's not going to be a right plan because life's changing. I mean, yesterday is different than tomorrow. I just want to know that you have that plan. I want to know that you've considered deep cuts, but you don't want to cut people, that you've just, the government's got some things about hiring in these loans. So that wasn't there yesterday when you did the budget. I just need you to be really sort of spot on and being that leader and thinking about it.
And so both Anthony and Mike, Anthony had a good question, and I think you've answered it. He's asking about what type of plan, how comprehensive. And I think the answer is the more comprehensive, the better, knowing we're going to throw it all out the window 60 days from now.
You might throw it out. You might throw it out the window tomorrow. I mean,
absolutely.
The world is evolving, but you have to know your own numbers. You have to know whether, I thought that story about the restaurants was amazing, right? Because everybody thinks the market's dead, but in fact, there's more delivery businesses popping up all of a sudden because Uber and Grubhub can't do it. I mean, Reading Terminal has got guys on a bicycle with gloves. So there is opportunity, and how can you capture that?
Yep. And then I do want to highlight, because not everyone, I think Mike asked the questions about, really hard to predict what's going to be there for 9 to 12 months from now, and creating a detailed plan, may not be. It's more about what are the real-time metrics as we go through this process. Where is cash? Where are people? Where are revenues? Where is growth? Like what happened yesterday versus today? Because Mike, I think it's great advice. I think it is just about as much as knowing in real time what's happening to your business. Because if you don't know that, then you can't project, you can't look to the future. Yes, new information is coming at us like crazy. And so I love that comment. I really do, which is, for me, the answer, Anthony, and I'll throw my 2 cents out there. It's a combination of both of those things. I want to understand, or we, meaning Ben Franklin, will understand that you will know your business well enough to understand the pieces and the parts that are going to break, where they're going to break, when they're going to break, and what those limits are. And then that you have a plan the plan may, to Mindy's point, the plan may be, if this doesn't stop in 60 days, my whole business is gone and we need to reinvent ourselves. That's not a great answer, but that may be the truth. And if that's the case, then, how do we give you another 60 days worth of runway? Because it may not take 60 days. So those are the type of issues on a company by company basis you need to really dig into. And so I don't know, I think, and I hate to push the question back, but valuation. And I know valuation should not be the number one thing. As someone who's done this for a long time, valuation is always one of the things. And so do you expect in these rounds, fundraising, down rounds? If an entrepreneur came to you right now and was at a flat round or an up round, what's the probability you say, like Doc, use the restaurant example. Are they coming to you right now and saying, oh, good, now we've got an up round, we're crushing it?
They are. Now this goes, but in that specific example, that was from a pool of capital that we can't invest from. We just don't have money from that pool. So they've come to us, but we're trying to help with introductions and help them through. But yes, there was an expectation of an up round there. But in our case, we just don't have access from that pool of capital because it's an older fund. But I guess to the valuations, look, one way to defer that, of course, as Nate and I both talk about, is doing a convertible note. Let things settle down. I do think that entrepreneurs should be prepared, depending on how much they need capital. If they need capital badly to achieve what they need to do, you should be prepared for a down round if it's not a note. Essentially, the way I look at it is, live to fight another day. If that is the only option you have and a note is not possible and you just need the capital and you have access to it, if an investor comes to you with what you need and he wants a down round, I think the entrepreneur should be prepared to accept that and fight another day. If he can avoid that and take less and perhaps take a different type of vehicle like a note and kind of curtail his business, I think that would be the preferred, cut his costs. That would be the preferred way to go. But with all those ifs, if there's no other option and they have an opportunity to get the capital they need to do what they need to accomplish in a down round, they should be open to that and fight another day.
Yep.
Yeah, if I could just add to it, there's some element, it's just math, right? We've got an entrepreneur we've been talking to for a couple of months, just gave us a revised plan for this year. They've just taken their projected revenue down from 2.5 to 1.4. Okay. So, and they did $750,000 last year. So at one level, they've just taken their growth rate down. That's their model to take their growth rate down. So our capital is going to get deployed to see them through this period, but not to be driving as much growth. At the same time, the public markets are down 30%. If you look at if you look at the public SaaS stocks, they're down 30%. Now, are they going to stay down 30%? I don't know, but the value of all the things you use to calibrate private markets to public markets have just been reset by 30%. So lower growth rates, lower benchmark, you're going to see valuations drop. Now, if you've got a company that's defying all that because it's like Doc's restaurant business or one of Mindy's ed tech business that's going the other direction and their projections just went the other way, we have a company that's in the ed tech space that actually received a term sheet last week in an up round from where they raised money 9 months ago, right? So it's there are things that are going to run counter to what you're seeing in the market overall. But in general, if your growth rate projections are down and your market comparables are down, valuations are going to go down. We're trying to. That's one reason, though. There's so much uncertainty that doing something in an unpriced round makes more sense because there's just so much uncertainty about what the downside really looks like if you look out, 12 plus months.
So
I just want to underscore the confidence. I think Nate said something that I think is really important, and that is put the cyclicals aside and up rounds. Investors need to be confident, and the market's just dropped 30%, but forget about where the market dropped, it's their confidence. So until that confidence comes back, you're not going to see even a flat round, in my mind, from unless the numbers are, hitting it out the park, et cetera. So I think that that's just a good thing to look at, and another reason to keep your eye on. And I'm just going to underscore what they both said: convertible notes, and don't raise that much during this. Raise what you need, because you'll pay for it on the other end if you overraise.
So let me switch gears and solve the issue that we're talking about right now, which is really survivability, and try to solve it another way. We can't raise capital. We don't have enough capital to get 12 months. M&A. You know, let's get sold. Let's merge. Let's acquire. Let's sell. You know, markets are down, so we know the price probably won't be ideal. But you know, surviving another day is another way to survive another day. And if you do that through M&A. Are you seeing activity there? And if so, have the rules of the game changed?
So I'll take that, because we have a couple of companies that were kind of going through process beforehand, and we have a couple now that we're looking to see if we can kind of roll into other entities. So the challenge with that today is all the meetings are virtual, right? Even the company that was having a process, all the meetings are virtual, and while they're going well, I just don't know if a deal can get done without some face-to-faces, whenever that'll be, a month or two, right? So I think that's one of the big challenges. You can have discussions. I think it is a viable option, to your point, Scott, if it's to fight another day. But it's just with the current environment, and obviously changing daily, I think it'll be difficult to do something without a face-to-face, unless it's somebody that you know really well, somebody you've done business with well, and they know you, and then you can maybe put something together. But broadly with M&A, it's moving, but until things shake out, I think it'll be a challenge to get done.
Anything different, Mindy or Nate? Yeah, I can tell you, Ben Franklin, because every week we have a company being bought, we have a company being sold, we have a company going under, and a company raising capital. That's the beauty of having such a big portfolio. And I don't think we've seen an M&A deal that is getting done. And even the ones, the great companies in our portfolio, some of which are on this line right now, that we're expecting an anticipated exit. I think everybody's doing I don't want to put money to work. I don't know if I want to do a new investment, and I don't want to buy something. And so, and I don't think it's because they won't buy it. I think right now, everybody, Nate, as you put out, I think, freeze. Like, this is a game of freeze tag. No one's allowed to run anywhere. Let's just see where everyone's standing. So what I would say is exhale and let time catch up a little, because yeah, the values may change on the acquisition, but I do think they'll open up again, especially as value buyers start to go shopping.
Yeah, I think that's right. I do think that you're going to see the PE buyers, there's so much money, they have to put that money to work. I think you'll see it come back faster than the corporates. I think the corporates are probably reassessing everything about themselves, unless they're running counter-cyclically as well. But there's just a lot of PE money buying, and not just buying for platforms, but rolling it into their portfolio companies. So if you're thinking about what the targets are going to be, I think that's where you want to look. But they're also recognizing that if you're really looking to sell today, they're not coming knocking on your door, but you're going out there and saying, I'm for sale, that there's a reason for that, and they're going to be discount shopping.
Yep. Yeah. So we did have a question, Mindy, unless you wanted to answer.
Well, again, I'm going to go back to underscoring, while the markets and certain things freeze, communication shouldn't freeze. So if you were in the process of perhaps an M&A or perhaps working with someone, don't freeze, don't go away, face into it, have the conversations, listen to what, whoever the acquirer was, because that's really important in these times.
All right. So we did have a question about an interest rate on a convertible note. If you guys don't mind, I will tell you, Ben Franklin uses an 8% interest rate. We've always used an 8% interest rate for as long as I can remember. That is an accrued interest rate rather than a current pay. And there's a funky metric in our docs, as you know, that they can change that to 0 if there's no revenue. So with that in mind, we're also a unique animal in that. But if you guys don't mind, throw out there what you think is market for a convertible note interest rate.
We've been using 6 to 8% for as long as I can remember. See, it's typically that's the range. That's obviously, I mean, for our perspective, it's not the most important factor for us. It's the actual terms, if they're what the cap is, things like that. So it's been 6 to 8%. We could probably move it by a couple points now if it's a benefit, but I'm not sure if it's worth the effort or important enough to us specifically. We're not a $1 billion or multi-billion-dollar fund where that could move things.
Yeah, it doesn't really drive our economics. It's really sort of it's really the discount to the next round and where the cap is. So same with Doc. I mean, we're generally in the 6 to 8 range. I do think that these are notes that are going to have a longer assumed life to them than, often sometimes as a venture investor, we'll do a convertible note. We're assuming that we're just bridging something to a next round, and this could be like a 6-month note. I'm assuming these are going to be like 18-month notes. And so that gets priced probably more into the discount than it does into the interest rate.
I'll give you my 2 cents. So I spent a short amount of time at the largest public company that did venture debt called Hercules. Not my favorite firm, but having said that, between 4 and 6% from an entrepreneur comment, 8% with another entrepreneur, the venture debt guys really want to yield about 12 to 14%. Now, keep in mind, that does include the upside from their equity kicker. And they're specifically structured as secure debt against everything. They're first out, the whole bit. And so if you kind of use that as a metric of, the expensive mezz debt is in your 12 to 14% range, your venture lender who's going to make their money on the equity and the conversion is looking at somewhere 4 to 6 to 8% to hold your feet to the fire. But that's not how they're making their money. And I think that's important to remember. Like, we're not in the business of making loans and getting an 8% return. That's not why we do this. And so that interest rate, at least for us, is less about the interest rate and more about just making sure that there's something there that the time value of money we're not losing on. All right. So we have about 5 minutes left before this is supposed to end. If there are more questions, kick in. I want to wrap up as we do this about just some parting words from each of you. I want to highlight and thank each of you before we do run out of time. Nate from Osage, Doc from SRI, and Mindy from Golden Seeds. They are there. They are investing. They are part of our co-investing programs. Your circle of benefits at Ben. Sorry for the commercial message here, but I don't get to do this often, so I'm taking advantage of it. And I want to thank the people that joined. I just realized I'm looking at the first screen saying, "Oh, good, 15 people joined." No, we got 75 people on the line right now, which is phenomenal, and I think it supports this region. It supports each other. And I encourage us, let's keep this rolling, because I think there is a strong community here. The more conversation we have, the more we can help each other. So before we end here, any parting words? And Mindy, since you went last earlier, I'll have you go first.
Am I muted?
Nope.
What are my parting words? My parting words are, know that we will get through this. There is another side. We've all lived, many of us have lived through this kind of chaos. This is a unique chaos. But as you just said, community is important. I'm not big on the social distance. It should have been spatial, because I think we all need to be talking to each other. And from a business perspective, really focus in and know that there are people who want to help you make it through. Whatever that means, whether it's fundraising or connections, just stay communicative, know your numbers, and protect your cash.
Excellent, thank you.
You're welcome.
It's interesting. So we've got a portfolio of 30 portfolio companies right now, and I've got to say that I am just in awe of our CEOs, and I'm in awe of those of you who are doing what you're doing and building your businesses. You've got a ton on the line. You've made a bet with your career. You've made a bet with your capital, and yet the I don't hear people saying, why is this happening, or feeling sorry for themselves. I see them being leaders. I see them, participating, learning, getting out there, taking the actions they need to take. And I think that that's just what makes folks like you start businesses, is you have perspectives like that. So stay the course. Ben Horowitz wrote a really great write-up on wartime versus peacetime CEOs. This is a time for wartime CEOs. Those who take that posture will recognize that there are tough trade-offs that need to be made, and it's really about getting through the war, getting to the other side, and there are tough decisions that need to be made along the way. And my bet is you're all prepared to do it, and whatever we can do to help, either in my role on the board of Ben Franklin or in my role at Osage Venture Partners, we'll do what we can to support as many folks as we can.
Thank you.
Yeah, same guys. Thanks for what you're doing, because you really are the front lines in this. And I think the message here is this too shall pass. You will live to fight another day. I think if anything, it's an opportunity to really look at your business and see what's working, what's not. How can you kind of gear yourself through this? So, like I said, we're very bullish on the region. And one thing about regional entrepreneurs from the Philly region is they have grit like no other. The entrepreneurs from here are different from some of the entrepreneurs we've backed in, we'll say, other regions on the coasts and stuff. So that's the good news. Our fund is here to help. We're here to bounce ideas off, to help make introductions. That's my job. And given that I have a lot of time on my hands now, please reach out. I'm not traveling, not doing anything. I'm here, so please reach out. I can truly say I'm always available.
Thanks, Doc, and thanks to all of you for joining. At the ability for us to personally thank you and clap, we would, but that's not going to work digitally. So, and I do run a tight ship. It is exactly 11 o'clock right now. We will be doing more of these, and we're going to have some other guests. We'll stop having to stare at my ugly beard, and we will have other members from Ben Franklin involved. But thank you all for joining. And JB, anything else you want to say?
You have me speechless, Scott. Let's keep it going.
Yeah. All right. Thanks, everybody. And you know what? We're in it together. So just keep holding on. We'll get there.
Yep. Thanks, everyone.
Thank
Good
you, Ben
luck.
Franklin. Thanks, Scott.
Thanks, Scott.
My pleasure.